What if an AI assistant could instantly transform torrents of overwhelming portfolio data into clear, actionable insights for your risk management team in seconds? I'm Richard Walker from Lucidate, and in this video we'll see how this game-changing automation is now possible using the remarkable capabilities of artificial intelligence. In this video, I'll demonstrate how AI can reinvent portfolio risk management to unlock human potential. We'll walk through an actual example of an AI system digesting raw hedge fund data and rapidly generating detailed risk visualizations, metrics, and PowerPoint presentations. You'll see firsthand how AI eliminates tedious manual tasks while surfacing deeper insights to help risk experts focus on judgment and strategy. By the end, you'll understand why AI is the future of finance. So stay tuned for a glimpse into the art of the possible. In this episode, we'll focus on risk management in prime brokerage. Prime brokers offer a range of services to hedge funds and asset managers, including securities lending, margin financing, trade execution, custody and settlement, cash management, and operations support. The first two services in particular are risky for prime brokers as they are lending stocks and cash to hedge funds, and they need to be sure that they will be repaid. This is where the essence of risk management comes into play. The consequences of prime brokers not managing risk came sharply into focus in March 2021 when the hedge fund Archegos caused a $5 billion loss to Credit Suisse and precipitated its sale to UBS. The stakes are high. In this video, we'll show how AI can transform raw data into actionable insights in seconds and ensure that this automation and information can be rapidly distributed around the firm. Let's zoom in on two of the key elements of prime brokerage: margin lending and short selling. Imagine wanting to invest more than you have to amplify your returns on your winning stocks. This is where margin lending comes into play. A hedge fund borrows money from their prime broker to purchase securities. This is called buying on margin. The existing securities the hedge fund owns act as collateral, a good faith deposit on the loan. But borrowing isn't free. The prime broker charges interest on this loan, and there's a catch. The investor must maintain a minimum balance known as the margin requirement. While this margin lending strategy can amplify gains, it can equally amplify potential losses. Then there's the audacious move of short selling. Ever thought a stock was overvalued? Short selling allows an investor to capitalize on this belief. It involves borrowing a security, selling it, and then hoping that its price declines. If it does, the short seller can buy it back at a lower price, return the borrowed shares, and pocket the difference. But if the price rises, they're in for a potential loss. And remember, borrowing those shares wasn't free either. Brokers charge an interest and a fee. Let's visualize all this with Apple's stock. Say on the 30th of January 2020, a hedge fund invested $100,000 in Apple when its share price was approximately $79. They'd own about 1,266 shares. Feeling optimistic, they borrow another $80,000, collateralized on this existing position, and buy more Apple shares. This adds roughly 1,013 shares to their portfolio, making their total count approximately 2,279 shares. Come the 12th of February 2021, Apple's stock climbs to about $133. Selling now would yield a profit of around $124,000. By leveraging, they've gained an extra $55,000 compared to if they just used their initial investment. Sounds lucrative, but remember, higher rewards come with higher risks. Now let's tackle short selling. Think a stock is overvalued? This strategy will be your play. Borrow the stock, sell it, and wait for its price to drop. Buy it back at the lower price, return the borrowed stock, and the difference is your profit. But if the price ascends, that difference becomes your loss. Back to our Apple example. 4 days after their sale at 133 on the 16th of February 2021, Apple stock has declined $2 to 131. Our hedge fund borrows 762 Apple shares from its prime broker and sells them. This generates $100,000. Less than a month later, on the 10th of March 2021, Apple stock dips to $118. Our hedge fund buys back the 762 shares it sold short earlier and returns them to the lender of the stock. This purchase cost just over $92,000, so the short position resulted in a tidy profit of nearly $8,000 in just a couple of weeks. Finance is a blend of strategy, timing, and a bit of foresight. While tools like margin lending and short selling can be powerful, they must be wielded with knowledge and caution. Let's look at what happens when things go wrong. If instead, on March the 1st, 2023, a hedge fund decided to short Apple's declining stock, if they shorted shares worth $100,000 when the stock price was around $144, then a month later, on March the 31st, with the price surging to approximately $164, the consequence is a significant loss of around $13,500. This example accentuates the volatile nature of short selling. When the stock price ascends, the losses can rack up. Then shifting our focus to July the 19th, the hedge fund takes a bullish stance on rising Apple stock. They invest $100,000 in Apple shares, each valued at just under $200. To strengthen their position, they borrow an additional $80,000, securing even more shares. However, the winds of the market are unpredictable. Just 1 month later, on August the 18th, the stock price has retreated to $174. This downturn, amplified by the borrowed funds, culminated in a large loss of approximately $19,000. These real-world examples emphasize a foundational lesson in finance. Each decision, be it strategic or impulsive, comes with its balance of risks and rewards. In this arena, knowledge is power, and risk management is a compass guiding the way. For a risk manager at a prime brokerage, establishing prudent risk limits and investment guidelines for a hedge fund is one of the most critical responsibilities they have. These limits create guardrails to prevent excessive risk-taking that could threaten the viability of the funds being financed and expose the prime brokerage to losses. The table summarizing the key limits illustrates how they contain different aspects of risks. Position limits prevent over-concentration in a single name. Gross exposure limits restrict overall leverage. Concentration limits enforce diversification across sectors. Limits on volatility, liquidity, and value at risk directly address market and tail risks, and margin requirements act as a buffer against potential adverse moves. Each limit provides a distinct form of protection. Used together, they form a robust risk management framework. Risk managers regularly monitor client adherence to guidelines and adjust limits as market conditions change. Setting appropriate investment constraints lets clients pursue their strategies while ensuring that the risks remain prudent. Limits turn the art of risk management into a science and are essential for prime brokerages to manage counterparty exposures to their hedge fund clients. Let's look at an example of one visualization tool to see how these guardrails work in practice. Analyzing a hedge fund's profit and loss histogram gives crucial insights into the hedge fund's risk profile. The histogram shows the distribution of a fund's daily gains and losses for the past 10 years. The width of the distribution indicates day-to-day volatility. Frequent large gains or losses are signs of high leverage. Of particular interest is tail risk, large losses that occur infrequently. Even a few extreme losses can pose a major risk. This histogram shows the fund has a small number of large losses exceeding 40 million in the left tail. To protect against tail risk, set initial margin or collateral requirements to cover potential adverse moves. One method is to take the average of the worst 1% of losses. Ongoing analysis of the P&L histogram allows us to dynamically adjust margins and collateral as the risk profile changes. By scrutinizing these distributions, risk managers can make informed risk decisions to avoid excessive exposure and ensure the prime brokerage can withstand market turbulence and fund failures. P&L histograms provide vital information to manage counterparty risk. A prime broker essentially helps power the complex trading activities of asset managers and funds, but one of their most important responsibilities is to continuously analyse and quantify the risk profile of each client's investment portfolio in order to avoid excessive losses. This analysis requires collecting tons of granular position data, running complex calculations, creating detailed visualizations, writing reports and distilling it all into actionable insights. An incredibly tedious manual process requiring days of repetitive work. So, how can artificial intelligence eliminate this drudgery, automate these rote analytical tasks, and enable human risk experts to focus their skills on high-level strategy and judgment? The answer is prompts and prompt engineering. By developing well-crafted prompts and injecting quantitative data into these prompts, the AI is able to generate a holistic and qualitative view. AI can do for qualitative information what Excel has done for quantitative data. Here's an application Lucidate has built that does precisely that, leveraging AI to completely transform the portfolio risk analysis process. Throughout the following demonstration, I'll show you the prompts that I've used to enable the AI to extract its insights from the data. We'll walk through a detailed example of how this AI system can rapidly digest raw portfolio data, extract key insights, generate interactive visualizations, and even build a polished PowerPoint presentation to summarize its findings. My goal is to show you firsthand how AI can reinvent risk management workflows to unlock human potential. Let's go ahead and load up a sample hedge fund portfolio to see it in action. Here I've imported an anonymized sample portfolio from a large equity long-short hedge fund, one that actively shifts its positions between sectors while maintaining both long and short books. Assessing the risk landscape for these long-short funds is especially complex. Prime brokers must vigilantly monitor the intricate and ever-changing web of exposures across the fund's long book and their short book. Too much overlap between the longs and shorts and the intended hedging effect of the combined portfolio can start to break down. So there are many interdependencies to unpack. All right, with our sample portfolio loaded, let's step through how this AI assistant rolls up its sleeves and crunches the numbers to extract truly actionable risk insights. First up, let's analyze this hedge fund's historical investment performance. The AI instantly generates a detailed drawdown chart evaluating the portfolio's past peak to trough declines in dollar value over time. Assessing these periods of historical drawdown allows us to quantify short-term liquidity risks. No fund manager wants to see their portfolio suddenly plummet. In addition to these insightful visualizations, the AI also rapidly calculates a multitude of key risk measures: annualized return, volatility, Sharpe ratio, Sortino ratio, and more. With an annualized volatility of over 18%, a 13.6 million maximum drawdown over 3 months, and Sharpe and Sortino ratios of 0.72 and 1.25 respectively, the hedge fund portfolio demonstrates a concerning risk profile that may not be commensurate with returns. A risk manager would advise reducing volatility and drawdown risk through diversification, risk management, and asset allocation changes. These analyses would normally require hours of manual number crunching by the analyst, but boom, with AI, instant automated quantification of the portfolio's risk-return profile. Let's keep exploring by inspecting the distribution of gains and losses. Here, our AI produces a helpful histogram showing the distribution of daily profit and loss realized over the past 6 months. Now, see those fat tails on the extremes of the distribution. Those indicate a heightened risk of experiencing rare but extreme losses, even if unlikely. Definitely a major red flag for any seasoned risk analyst. With significant tail losses representing over 3% of the portfolio's value, the P&L histogram indicates a high risk from extreme events. A risk manager would require margins of several $1 million to cover potential tail losses and recommend liquidation if losses exceed this level. Putting together these detailed histograms by hand in Excel used to require extensive manual setup, drafting formulas across endless rows and columns, but the AI generates them on the fly with barely any setup. All right, now we've assessed past performance, let's shift to examining interdependencies between the current positions. Leveraging this interactive 3D surface plot, the AI can analyze the intricate correlations between all portfolio positions across time. Stocks exhibiting a high positive correlation have visibly high peaks, meaning they tend to move in sync, amplifying overall portfolio volatility. This concentration presents risk, like a domino effect. On the other hand, securities spaced very far apart exhibit negative correlation and tend to move opposite one another. This dispersal and hedging effect is key for diversification. With high positive correlations near 0.8 to 0.9 between several major technology names, the correlation matrix flags considerable concentration risk dependent on precise portfolio weights, underscoring the need for additional margins to buffer against potential sector-specific losses. Moving on to sector concentrations, with a few clicks, the AI instantly highlights any significant industry or sector level concentrations through these graphical sunburst charts. We can clearly see at a glance where this portfolio's risk exposures are concentrated. This helps us identify the market segments that could disproportionately impact performance, for better or worse. While the long portfolio has positions across 10 sectors, it's heavily concentrated in information technology and consumer discretionary, including major names like Apple, Microsoft, Nvidia, Amazon, and Tesla. This implies higher risk as these volatile sectors account for significant portfolio weight. In contrast, healthcare, utilities, and real estate have limited exposure, restricting upside potential. With the $37.5 million short portfolio concentrated in communication services, especially internet media, the fund's performance depends heavily on this sector declining. The AI analyzes these issues instantly and holistically. No more squinting at densely packed Bloomberg screens and manually filtering pivot tables. The AI provides instant clarity, allowing us to make informed decisions. Finally, the system provides this invaluable aggregated view of the granular long versus short exposures across the portfolio. Though diversified across sectors, the long-short portfolio makes concentrated bets on consumer discretionary and tech longs, and financial and communication services shorts, significantly tying performance to specific sector calls. This high-level summary is perfect for rapidly assessing the overall hedging effectiveness between the long book and the short book. With older manual methods, analysts struggle to efficiently synthesize these rough position exposures, but our AI makes it seamless. Now, here comes the true power and potential of AI. As a final step, we can direct the system and prompt it to automatically generate an entire polished PowerPoint presentation containing all of the analyses and visualizations it previously produced. This is an absolute game changer. Rather than forcing the risk analyst to manually construct slides from scratch for hours or days, painstakingly copying and pasting charts, typing up summaries, the AI handles all of the repetitive heavy lifting. This frees the human expert to dedicate their specialized skills and judgment to higher value areas like strategic decision making, portfolio optimization, and direct client service. The efficiency gains here are truly exponential, reducing days and weeks of mundane presentation work down to seconds or minutes. This is how we unlock human potential. In closing, I hope this demonstration clearly conveyed immense possibilities of applying AI to reinvent portfolio risk management workflows by seamlessly eliminating repetitive manual tasks and surfacing deeper data insights. AI enables risk experts to focus on the high-level judgment and strategy only humans can provide. If you're interested in witnessing more live demos of AI's potential to transform finance, be sure to like, subscribe, and stay tuned to the Lucidate channel. I'll see you in the next video. Until then, take care.